If you like real robust edges in the market, not just fluff, make sure to hit that like button to subscribe. Today, we're diving deep into market regime trading, one of the most underappreciated but powerful approaches in the trading world. By the end of this video, you'll know exactly how to spot changing market regimes and adapt your trading strategies to the new game. So, without further ado, let me share my screen and let's get to it. S&P 500 chart, going back to global financial crisis 2007. The first thing I want to look at here is just realize the market goes up. And specifically, we're talking about individual markets. This is super important to understand, okay? Not every market is the exact same market. The S&P 500 represents the top 500 companies on US listed exchanges, the top 500 companies in the world or so. In an economy that is constantly growing, the leader of the world and has the global reserve currency. And so that's why it's kind of ridiculous to always try to be short selling a trending market. Now, this is a chart of, every week. It's not a daily chart. It's not a 5-minute chart, not a monthly chart, yearly chart. It's a weekly chart, S&P 500, since before the global financial crisis. Okay. The worst economic environment in our lifetime, at least mine, was right here. And if you look at it, it kind of just a blip, right? We had the 2020 scenario, you had the 2022 bear market, like all these things are just kind of cute relative to where it is right now. If I was to look at currencies, not cryptocurrency, but like currencies like the euro, like the yen, they behave differently because they have entire economies that transact in it. The S&P 500 is an investment in companies, and itself is a strategy, right? They kick out the worst companies and of the 500, and they add in the 500 best. So they're constantly optimizing to the best. Okay, so the S&P 500 is the top 500, the best we have to offer. So it's built to do it that way. If I was to take a look at something like the euro, it's not built. The currency is not built to go up in a way like an investment like the S&P 500 is. Have you ever been on a winning streak so good and you were just conditioned day after day to do this, week after week, whatever it was, to do the same thing over and over? You could do no wrong. Yeah, you had a loser here and there, but for the most part, it was just constantly, I wake up, I do the trade, I go on with my life. It's Monday morning, I put this trade on Friday, I take it off, or whatever it is, and it worked. It worked for a period of time. And you thought to yourself, I finally figured this out. I finally figured out this trading. And that's when you start scaling up, right? I'm looking at which jet I want to order. That's usually your first sign that you're about to get kicked in places. When it happens, it's because the market has shifted into a new regime. Let's say another really good example is, as you start out, you kind of buy you buy the market and it starts making money, you do good, and then you think, okay, I want to get into this trading thing. And, oftentimes we find, or short selling even, oftentimes we find that works for a while. And you do good with that mean reversion. You short the tops and buy the dips, and it just crushes. And then one day it just takes off, right? That's a shift in the market regimes. Okay. One moment everything's clicking, and then the next it's chaos. It's because markets move in cycles. They have bullish, bearish, and sideways regimes. Each regime has a volatile or a quiet version. So a low volatility version of it or a high volatility version. Okay. Each one of them should be traded differently, whether you move off to something that is in the ideal regime that you're used to trading, or you trade a different strategy of the same thing within it. So when I talk about market regimes, I want to paint this picture for you, give you an idea of what it is. It's like seasons, okay? In the middle of winter in Canada, would you be worried so much about which flip-flops and shorts and tank top you're going to be wearing? Probably not. You're going to be focused on the heaviest, warmest coat you can get with boots and gloves and hats and staying indoors as much as you can, probably, unless you're really into the outdoors, then you're out skiing and doing stuff. Same thing. If you're in Hawaii and you're packing bags to go there, are you thinking about which big heavy coat, gloves, jacket, everything that you're going to be using in Hawaii? No, it's like, okay, I'm going to pack two pairs of flip-flops, a couple pairs of board shorts or, swimsuits. And, worst case scenario, if it gets wild, maybe I'll buy something there. But in other words, you don't have to worry about ski, like, snow conditions in, like going to Maui, going to the beach in Maui. You don't have to worry about middle of the winter blizzard conditions. And that's the same sort of thing with market regimes. If this right here represents the 2022 to 2022 bear market. Basically everything that worked all the way here stopped working here and really just kind of destroyed a lot of people, because what happens at the very end of a big bull market, everybody's in the game, everybody thinks they're smart, everybody's borrowed money and done all these things. And when it switches, they think that, oh, well, buying the dip worked the whole way, so I'm just going to buy dips. And usually what happens is, because they're leveraged, because they're using credit, or, because they've been so focused on trading big tech to the long side, maybe they got crushed. Okay. And, it lasted 10 months. The peak happened in December 2021. January 2022 was like the real peak. I think Thanksgiving was kind of like the US Thanksgiving. And in October of 2022, that bottom hit. And so a lot of people who made money in this area weren't prepared for this. It all happens the same. Now, something that's notable here is that when it does go down, it's quick. And as it rises for a long time. So this was 10 months to the bottom. Okay, this was 1 month. This one here, 1 month. This was 3 months here. But you'll notice that the big up moves, even the things that felt horrible at the time, are just barely a blip relative to the bigger thing. So in the market you're trading, it's super important to have that knowledge of what it is, right? So the most common problem I see is traders stick to one strategy, whether we're talking about, a long only bullish strategy, which is the most common for newer traders to have, and older traders. Kind of the middle traders get caught into the mid curve trading everything. When market's trending in a bullish environment, everything seems, relatively easy. You see people who don't know very much about the market making a lot of money, right? You see people who think they know a lot about the market losing a lot of money because they're constantly thinking about the Fed or interest rates or news. Their brokers against them, the market makers out to get them. But the reality is they are trading the wrong strategy in the wrong environment. There's so many stories in financial markets about the big short, which, that was here, getting short the housing market in 2007, 2008, catching the big, bubble bursting, shorting the dot-com bubble, catching the dot-com, like there's so many stories of big successes being a contrarian. The thing about contrarianism is it's really easy to be a contrarian when it doesn't need to be. It's very hard to be a contrarian when you need to be a contrarian, right? At the very bottom in February, March of the global financial crisis, the contrarian move was to go long. Everybody was convinced the market was going to crash further, and it would be 1929, Great Depression for decades, and all that. And then from there, it just pumped right along and put in new highs. Okay. In 2020, there was something that happened in the world, and we all, everybody thought the world was going to end because of it. And in 3 weeks, it stopped and turned around. The thing is so many folks were so convinced that the market was going to, 1929 Great Depression type move, that they kept trying to short it the whole way up. And it wasn't even until like maybe in 2021 where people finally capitulated, be like, okay, the market's going higher, which is the top. The reality is, it's, if you're trying to think about these sort of things instead of using some sort of statistical edge to help organize the market for you, that's when you get kind of lost in on it, in all of it. So what if you could anticipate the changes? Imagine having a system that could give you an indication that what is currently happening has a possibility of changing. Now, the market regimes are like very lagging indicators. I want to make that clear. You're not attempting to guess the exact day. You don't often figure out the exact day that the temperatures and the snow is going to end and everything's going to change, but you know that certain times of the year it's going to be that way. Middle of summer, where I live in Arizona, it's going to be 110, 120 degrees. If it drops to 104 or even like 98, it's hard to predict that that's actually going to happen, but it's very easy to predict that you're not going to have like a 50-degree day and it's not going to snow. You can almost with complete certainty guarantee that that won't happen. Okay. So if you could understand that you were getting into, let's say you're in a bull market and it's getting into a lower volatility bull market, it's moving into a higher volatility phase, that tells you something. As you get into a higher volatility bull market phase, meaning the daily moves are bigger than they have been. Quiet move is just kind of a little bit. When you get to these bigger up moves, that's indicative of a change. That opens up the environment for a market top to potentially happen. Okay. But when you're in this quiet phase where it's just up, nobody's stressed. Everybody's kind of like, I don't know, is it bullish? Is it bearish? Is this the end of it or whatever? But when everybody's like, oh, the moves are so big and, we had a 20% gap up on Tesla or, something like that, that's indicative of more of a high volatility market top environment. Okay. So if you're aware that suddenly you're in a high volatility bull market or a high volatility bear market, the high volatility is the indication that something is about to change. Okay. And so what has been working has an opportunity to stop working. So it's not so much telling you short the market by any of those sorts of things. It's saying, okay, limit your risk. No longer are you in an environment where you understand what's going to happen most likely. Now you're in an environment where, yeah, it might not be there. So let's get into a couple of simple ways that we can do it. Okay. We can identify market regimes and use those as reference. And so the first one I want to talk about is a very simple, let's go here. This is a moving average crossover. Okay. So the white line is an 8 period. The blue line, I think that's blue, is a longer period. So 8 period and a 21 period EMA. This is a weekly chart of the S&P 500. Okay. So one thing I will say is that, first of all, when the fast is the white line, the 8 period EMA is below the blue, that's bearish. When the white is above the blue, that's bullish. That's a very simple way to look at a market regime. Now, this in here, you're saying to yourself, that's not very helpful, Chris. It's, there was almost 2 years that it was kind of like back and forth. Yes, I understand. That is also telling you that if there's no clear explanation to it, then that's a different type of market regime. It's not a bullish and it's not a super bearish one. It ended up being bearish. You could see it. But as we know on the S&P 500, it does not go down nearly as much as it goes up. So if we just look, let me just take this off. I'll hide it. And you can see, like, you're not even looking at the let's go log. Easier to see it that way. It's just almost straight up, right? This would have been, I don't know what happened here, April 1991. It would have been something happened in, oh, it's just lines that don't need to be there. That would have been like the invasion of Iraq in the first Gulf War. But you can see that ultimately back to the 70s, it's straight up back to the 1800s. It just goes, it just goes up. Yeah, it goes down. So what you could do using this simple sort of market regime tool is say, okay, when the slow period is above, or the fast period is above the slow period, we're generally looking to be long until the fast period goes below it. Okay. If we ever get an opportunity where price goes down to our slower period, but the moving averages are still sloped up, that's a buying opportunity. These are ways to go about it. It's very simple, but that's what we're talking about. I'm not telling you that this is the most dynamic trading system in the world, but this gives you an idea of the market regime. Looking at it today, in the, coming into fourth quarter, the end of third quarter, fourth quarter 2024, at this very moment, it's bullish. It bottomed in October 2022. So that's 2 straight years of relative strength, quite a lot of strength. Okay. And we've had a couple of good buying opportunities that came in here. This one was a little tricky in November of 2023. So last almost a year ago. But you can see that from there, it just goes. Okay. You could say, all right, well, if it ever goes below, as long as it's above that, I'm long. If it ever closes below the fast, I'm out until it goes long again. Boom, catch it, closes below again, I'm out again. And so there's a number of ways to do it, but what I'm not talking about market timing, I'm talking about regime. How do we deal with this environment? Okay. So it's the purpose of it is to keep you on the right side. Okay. Let you say, okay, in relationship to previous times in the market, you now have something a 10 and a 50 moving average. It doesn't have to be the 8 and 21, and it doesn't have to be exponentials. You can do it however you want, but you want to make it simple. And you want to make it in a way that will just give you a general idea. Okay. We're generally bullish. Could we be topping? Sure. The market regime tool is not giving you something to say that's the market top. That's not what it's doing. What it's doing is saying we are generally in a bullish market environment. So now let's either go study previous environments like this and see what information we can get from it. That's one way to do it. So you now have something to relate it to. So I can go back and say, when was give me periods of time where 40 weeks or more of the fast moving average was above the slow moving average. And you can go and like chunk this little environment and see if you can find other periods and see what characteristics were there, right? This one might have been October to, there was like a year and a half period. Okay. But that eventually came in down and got quiet. And, like you can compare them historically. Here's another one that lasted quite some time. So you can go get characteristics of that and see if they match on our current environment. All right. So that's one way to take a look at it. Okay. Again, this could be a 20 and a 50. You could do this on a daily chart, right? You can see it's a lot choppier on the daily. You could do it on an hourly chart and say, okay, as long as we're above it on the hourly, we're in kind of, at this point in time, it's like a mean reversion because it goes up, it drops, it continues to drop. So you would either say, I buy at the bottom one, or when it's over the top, I look for a place to sell. But all that's giving you is just very little short-term periods. This is back to July. This is, all-time high here into September. The lower you go down in time frame, the more tactical it is. The more of a trading system it is as opposed to a market regime. Okay, so the next one I'm going to look at here is, let's take that back to a week so everything's the same. The next one I want to look at here is the ATR. These are volatility based tools. Okay. So what we have is, again, we have our exponential moving average crossover on the weekly S&P 500. But what we have down here is the ATR, the average true range. Okay. And the average true range, is that percent smoothing time frame? But what you want to do is you just want to compare other periods with the current period. It will do. That doesn't give us a lot. This one I like to do in slower or faster time frames, more of a daily. Okay. So if we're looking at ATR, I want to see daily, because one thing we know about volatility is it changes quickly, right? This March 2020, this thing went from very low volatility, period of very low volatility down here 20 on the ATR, to 150 within, 2 or 3 weeks. That is uncommon. You don't see that. So what I like to do is then say, okay, typically what happens, you have low periods of volatility, which is when the market's rising. So if ATR is declining and market is rising, that is a low volatility bull market. So if you can see price rising, here's a good example right here. Okay. So we're seeing, draw the line so it's easier to see. So we have declining ATR and rising price. So the part that's interesting here is that the ATR suddenly started to go high. Okay. So this is actually a lot more actionable than using the moving averages. Do you see how now you can kind of layer this in, right? You see we had, actually, let's just put lower lows here, right? ATR just kept lower lows and price just kept going higher and higher. Okay. So as you get this decline, you start thinking to yourself, okay, as long as ATR is going lower, I'm good. When ATR starts rising, I got to start pausing. You can see it happened over here, right? When ATR started to rise right here, that's when price declined. Okay. It doesn't always work that ATR leads the peak, but in a lot, in this circumstance, it certainly, this showed a blow off top type environment in a short-term basis. So down, 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 up. Once we got to here, so this one right in here, give you an arrow, right in here is when ATR started to change things, because that was a big down day, right? This was the first time we'd had, it's like a 1% down day, not a huge down day, but we've had up day, small down day, normal, up day, normal, down day, normal. So when you start getting multiple days of up and then a big down day, that's indicative of a blow off. Like people are taking profits. People have bet too much over here on the upside and they're getting stopped out. So these turning points are very volatile. And so when you see rising volatility, that's an indication to you to say, okay, I'm going to cut down my position size. I'm going to cut down how much trading I'm going to do because it's just too volatile here. It's too risky. Okay. So this is a great example right here of price kept rising, but the range started rising. That's your take profit sort of scenario. Okay. And then you get a breakout, and that's when we had this big August meltdown crash. And you can see we hadn't gotten that high in ATR since we were higher than the market bottom in 2022. So this was a very significant move, the August 5th crash, mini crash that we had there. Okay, we are declining ATR and price is still rising. Okay, so given this knowledge, it doesn't mean, like, again, this is not telling me on the day-to-day how to trade every hour, every minute to trade this thing. It's just telling me, okay, this is bullish because our, EMAs are up. We're above the fast above the slow, and our ATR is declining. If this changes, something's gonna, it's gonna be worth noting. So it's up to you how many periods you want to average it out, and your moving averages, it's up to you. But right here, right now, this is still a quiet volatility environment. And that signals to me that we're probably going to have, we're going to stay in a bullish area for a little bit more. Okay. When this starts rising, you can see this was declining sharply and price rose quickly, really quickly, and then went sideways. And when ATR lifted, prices kind of dumped. So the ATR is like an inverse indicator, and its job is to give you the regime to tell you like the volatility is trending lower. Now, if that jumps, then we have to look at price maybe changing it. So that's how you would trade that, right? You would look at it and you say to yourself, okay, I can't, rising ATR means rising volatility. Rising volatility usually indicates a reversal for a short-term period. Declining volatility is more of a trend, especially when the trend, it's following a trend. So as this happens right here, just banging around sideways here, this was like a super easy indicator of the staying in the market. That just went from, November 2023 till April. So 6 months or so of just day after day up. And then eventually you got some craziness here. And as this declined, you start looking for a reason to get in over here. And there you go. Write it out. So the ATR is another one. Now I'm going to throw this up here real quick, the VIX. It's harder. I don't personally use the VIX. The only thing I would say is that you can use the VIX volatility index to say, maybe if it's above 15 or 20 or something, you don't take any longs. Or if it ever gets above 30, you start looking to buy the dip or something like that. I'm not going to use the VIX too much. I don't use the VIX actually much at all. And I'm going to talk about what I actually use. My preferred tool, here it is. My preferred tool is the SQN indicator. Okay. Now, this is a free indicator on TradingView. Go search SQN Christie Fallible. Okay. On TradingView, it's free. Feel free to just grab it. And I'm going to explain how I use it. Okay. So we're going to go, I use this on a daily chart. Now, let me make sure my settings are correct. Oh, sweet. Okay. So the settings here, I like to look back 100 days. Okay. You could be a little bit more precise with it at 121, I think. If there's 22, 21, 22 trading days per month, pick the metric that you want to focus on. I like to use around 100. It would be 132 for a 6-month period. Half of that, so 60, it's like 63 or something like that, or 66 for a 3-month period. But the idea is that it tells me where we are, and it's color coded for me. Now, I'm not the best with colors, but I can definitely see these colors are good for me. And I know what each one is. Okay. So one thing it's great to look at is when this thing is below 0, it doesn't mean it's bearish. When it gets into the red zone, that's actually bearish. Okay. That red down there happens very infrequently. It happened in 2022 during as the bear market happened, and eventually we bottomed. It happened in 2020. It happened in 2018. It happened in 2015. It just tells you the environment that is potentially available. So we in the summer of 2022, we knew that we were at really low levels on that. Here was the biggest one we've seen, I think, ever, was the global financial crisis. But what you can see is that whenever it gets below 0 and whenever it gets red specifically, that's a great time to say, okay, the volatility is very much to the downside. Okay. So we're either going to be short-term shorting the market and being low risk, so low position size. And also we're open to the idea that the market could very well turn right there and start going higher, because we're talking about the S&P 500 here. That's what it does. It goes higher. It's built to go higher. We have central banks and governments all around the world who will step in and do things to make sure it goes higher. It's hyper manipulated in that sense. If the market crashes, governments react very quickly. If the market like rips to the upside, they're very slow to slow that down. They're going to step in and do big things if it goes down quickly. They do that. So it's just understand the game you're playing and be on the right side. Now, when it gets into this blue stuff, so green is called the bull quiet. That's the Goldilocks. That's the nice trending higher market. When it gets into the blue area, that's when you got to start worrying about a market top potentially happening. So I like to use the SQN as a multiplier, inverse multiplier of my position size. So if I'm getting long down in here, these are like my biggest positions. Okay. As it gets into the green, I'm lightening my positions. And as it gets into the blue, I'm really lightening my positions. Okay. So I don't know, buy 1,000 shares of SPY down here in this area, 500 shares here, 100 shares up here, because it's a measurement of the average daily range. And so what that gives you is a, where is it here? Gives you an equity curve that looks like this. Okay. Because you are big size in here, half size in here, tiny size up here. Okay. But because this is moving, up at the top, you're getting day-to-day moves that are multiple, 0.5%, 1% combined gives you like 1.5%. Whereas in here, you're in this period, well, better here. You get smaller period or smaller changes in the day-to-day changes. And at the very bottom, it's like it barely moves. It's just and then it actually has to reverse direction. So I like to, if we're kind of using, let's use, so low volatility equals higher position size. Let's get that over a little bit. Mid volatility equals mid position size, and high volatility equals low or zero position size. Okay. And like I said, what that'll do, that'll give you the smooth equity curve. What people tend to do is they're down at the bottom of the market regime here. They're down here at the lows and they're buying just a little bit. I'm going to nibble here. If we're down in this area, it's not that you need to just buy it. The market regime is saying this is this is reversal area or low volatility. And since this thing tends to go higher over time, you would look to start building your positions here. Okay. So a little bit bigger position size, a little smaller, so let's say you went and bought 1,000 shares. And then as you got in here, you start peeling it off a little bit, cutting it down, cutting it down, cutting it down, cutting it down, cutting it down to where you might even go completely flat or, other ways. That's like a big understanding. You don't need, when it's at the very top of the volatility, you don't need big size to make your, money. The moves are going to be bigger. So let's take a look at 2020 here. Okay. This was crazy times. Okay. We went through nice August of 2019. So as the fall happened, we had 2018 was a bit of a wild year. Let's go back to that. Okay. Notice where 2018 peaked. It peaks in this blue bull volatile, highly bull volatile regime. And instantly we had a crash. It's called flash crash. Okay. And that was set up from this trend, this just perpetual bid that just kept going higher and higher and higher and higher. And everybody was like, there's no way this is happening. How is this happening? This is crazy, blah, 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 blah. Finally, everybody was like, well, I have to be in over here. And you'll notice that if you look at it, it's just almost day after day after day after day after up day. Okay. For the year. And eventually you start thinking to yourself, okay, that's crazy. So is there, I was going to throw ATR on it, but I'm not. Then we had a crash, and we spent the rest of the year, well, the next so 2018 we had a bit of a crash into, so we got new all-time highs, and then we crashed pretty hard into Christmas Day. And as we get into the red area, that tells me, okay, it's time to start looking at reversing higher. Anytime it goes below zero is when you start thinking to yourself, okay, like this is a spot I want to consider a reversal. But when it eventually made it into the red area, which, right about the beginning of December, is when it got the most volatile. So we're now neutral, neutral, bearish, neutral, bearish. Now we're into bear, and the volatility is rising, okay, as price declines. So you can see the days are big, big, big down days. That tells you that big, big, big down days means the government's going to come in and do stuff. So you don't have to just buy it because it's in the red. You start looking at places to where you would be comfortable doing it. The best spot to me would have been like right over here, using what we know from these little things. Okay. Just like right over here, when you got your cross up over here and everything started, it was like nice and quiet. This is in this area. So this is 2,600 all the way down to 2,300. So it wasn't a huge, you didn't miss a whole lot by buying it, waiting until it gave you a bit more of a confirmation. Okay. And then it just, started going. We get into the summer of 2019. So we made back almost up to 3,000. Can't do it. We have a little bit of a volatile summer there where it's trying, does get above 3,000, falls again. It's just, it's a tough, 2019 is tough. So volatility was high, not a lot. It wasn't easy to make money. It was a tough environment. And then it just starts taking off. So the sideways flip-flop over here is indicative of, a market regime of just indecision. This is like currently like crypto, like it rallied and then spent so much time kind of trying to figure itself out. And then it does. Okay. Then it goes. So we rally into the end of the year. Then we're into 2020, still into we're into January now. It's starting to get a little volatile. Why? There it is. You can see volatility is rising at the top. Okay. So it continues to give you that signal of like, okay, lighten your volume, consider stuff might change here. And it does. We know what happened here. Try not to get penalized, so I won't say it. Freedom of speech. And bam, a huge sell-off. And now we're into the red. Once we get that red, that tells me, again, what do I learn from it being in that area? It only happens about 10% of its entire life that it ever gets into the red. So I start realizing, okay, this is where you want to buy. And again, once it got into it, I got long on the 5th, I think. Here's where I got long. That was a little early. Better could have been right in here waiting for the crossover. It just kept going. It just kept going into the 2021 top. So over here, we got nervous. We closed out of positions. We got out of the way. Look what happened instantly. Boom. That was into the election season. Once it cleared itself out, it took off again. Okay. Into more volatile areas, and it peaks and then starts kind of doing its thing. And then it just trends and trends into the summer. We're getting a little volatile up here. Let's watch ourselves. Oh, it's giving it back. Okay, no big deal. It's still in there. And finally, again, we're getting that signal. We're getting all these little things. We're getting our crossovers. Still looking like it's probably going to go. And then it just instantly just goes down. So you're like, okay, well, if I'm using the EMA here as a guide, this is starting to give me warnings because we're having multiple of them. This is giving me warnings because it was a big pullback. Like as that moving average crossover happens, around volatility, you start realizing, okay, things are happening. And then again, as we get into the red area, you start looking for a reason to potentially be long. So you buy this. I was wrong. Okay, this one here, you can buy in this area over here. And now you have lower lows. So this is stuff to kind of keep an eye on. You have a lower low in price, but your regime is telling you, no, volatility is getting lower. Price is rising more often than not. but price went down. So that's where you start thinking, that's where you start seeing the divergence, and you go try to find other cases like that. And that ended up being the place. We had another, dump down into here and another indicator to say, hey, this is probably the spot. And again, it was, in that area. And then it just took off. So that's how I'm using it. Markets evolve, regimes shift, and you have to stay on top of it every day. As I'm looking at it today, I'm looking at this to myself, and I'm seeing low volatility, bull market today. Who knows what tomorrow is going to bring? But right now, we're in a low volatility bull market, getting close to where it gets peaky. We have our moving average crossovers are in the direction that we want them to go. If we were to put this on a weekly chart, it's just strong. So any chance you get to buy in these areas here, it's a great thing. So here, yeah, I'm just, it tells me buy dips. If you get an opportunity for a dip to come down here, look to buy it. You want to, you don't want to be buying the breakouts so much as any sort of weakness is an opportunity to buy. That's how I'm looking at it, and that's how I trade them. Okay, so that doesn't mean that this is the way to do it. Go out, find these examples, apply, look at how your system's traded. If you're a day trader, if you're a swing trader, whatever, look how your systems reacted in these different environments. Write that down. Go get that documented in your spreadsheets. Get that so that you know that your average daily range in a declining ATR, or when the EMA is above that, your average daily range, how many times it's up, how many times it's down. Start getting that information. You can build real systems around that. Okay. This is what we do every day at Pollinate Trading, pollinatetraining.com/lab. You can come join us. This is what we do. This is how we organize the market. I write algorithms to actually do this with my trading, so I'm not just guessing at this sort of stuff. This is how it is. Right now, we're coming up on the last little bit of the trading day. We have an overnight trade that we like to put on when things are in our favor. We'll see how that is. It's been fantastic. It's just awesome, awesome environment to be in. Okay, everybody, have a wonderful day. I will catch everybody